So I want to introduce you to Christy Thomas. Christy Thomas is the Community Relations Senior Consultant for Wells Fargo in the Greater Charlotte region. She has been with the company for 23 years, primarily in various marketing roles throughout the bank, including wealth management, consumer and student lending, and corporate marketing. Through the Wells Fargo Foundation, Christy supports community investments in the areas of public education, community development, and arts and culture. She also encourages team member volunteerism and community engagement with close to 27,000 Wells Fargo team members in the Greater Charlotte market. Christy is an active community volunteer and currently represents Wells Fargo on the board of directors for Read Charlotte, a collective impact initiative to double the number of third graders reading on a grade level by 2025. Christy has a certificate in nonprofit management from Duke University. She graduated from Miami University with a BA in International Studies in Spanish and studied abroad in Costa Rica through the University of Kansas. She resides with her family in Cornelius, North Carolina. I will let you take it from here, Christy.
All right, thank you, Grace. I really need to do a better job of shortening that bio because that was a whole lot of information. But good morning, nice to see you guys. I will add one more thing. I have a college student in my house right now. My son is a junior at DePaul University in Chicago, and like many of you, he's doing classes online right now. So I was talking to him yesterday about what I needed to present to college students around credit, and he said, don't spend money you don't have. So that was his college advice for our presentation today. But really good to be with you guys this morning. I know you had a great session with Jonathan. I'm a huge fan of Jonathan and his organization, and sure, he will be a hard act to follow, but I'm going to do my best. So I'm going to pull up my presentation here. This is welcome to everything you ever wanted to know about credit. Excellent, thank you. Okay, so this is everything you ever wanted to know about credit. My goal is to try and make this a little bit interactive, and so I hope that you'll use the Zoom tools to engage with me. And I told Grace and Catherine that the presentation part is about a half hour or so we'll have lots of time for questions. I hope you guys will ask questions. I put a couple breaks in as we go through the presentation, and we should also have time at the end. So write things down as we go, and we can talk more throughout the presentation. So here's our agenda. We're going to do a couple of things. We're going to talk about what is credit. We're going to talk about why is it important to me. We're going to talk a little bit about your credit report, your credit score, and how having a higher credit score can be a really good thing for you as you work through your financial career. And then finally, we'll wrap up with some tips and ways to avoid getting into trouble with credit. So to start off, I sent you all a quiz in advance about establishing good credit. Hopefully you had a couple minutes to look at that earlier, but what I want to do now is just sort of go back through that. I think it might be a good way for us to sort of test your knowledge and see how you did. So here we're going to try and test this again and see if I can pull up that quiz. Let's see. Okay, can you all see this quiz now? A little bit? Yes? No?
No, we don't see.
You don't see the quiz?
You see your slideshow. I think you have to do like a new share.
New share. See, this is why I need you all on here to help me do this. Let's, thank you all for your patience with me. Okay, how about now?
That's perfect, Christy.
Excellent. All right, thanks again for your patience. All right, so let's go through this quiz. And what I'd love for you guys to do is if you, this is a true false. So if you think the answer is true, Give me a thumbs up either in your camera or use a reaction, and we'll see what everybody's opinion are on these different questions. So question number 1, true or false? Avoid getting a credit card until you are a homeowner. All right, I'm moving it over so I can see what you guys are doing. True, false. Everybody's doing a little bit of like, not so sure. All right, the answer to that is false. And we're going to talk a little bit about why you want to start establishing credit so that when you're ready to purchase a home, you have that history ready to go. Number 2, open a savings account or checking account and manage it well. True or false? Good, getting lots of thumbs up on that one. That's an easy one and a great way to get started in terms of starting your financial management. Question number 3, never spend more than you have in the account. It reflects your ability to repay loans. Good, lots of thumbs up on that one. That seems like a pretty easy one, but we'll talk a little bit more about some guidelines on how much you want to spend, how much you want to save in that case. Number 4, get multiple credit cards at top quality stores and skip making payments on occasion. Yeah, thumbs down on that one. So the first part of this one, we're going to talk about how you might want to have a couple cards. The bad part of this question is the skip making payments on occasion. Obviously not a great idea to build your credit history. Number 5, get 1 or 2 gasoline or department store credit cards and pay your bills on time every month. Yeah, that's a true one. And we'll talk a little bit about why you might want to consider like a gasoline card or department store card as you're starting to build your credit in a couple minutes, and obviously paying on time is a good thing. Number 6, only borrow money from family and friends. Yeah, that is actually a thumbs down. That is a false one. And the reason that you don't want to only borrow from family and friends is if you do that, you're not actually building a credit history. And so when you go to take a loan, there won't be anything for a lender to look at to say, yes, this person has the ability to pay back a loan. Number 7, use cash advances from one credit card to pay the balances due on others. Yeah, this should be a really easy one. Not a good idea. And we're going to talk about cash advances and why those are an even worse idea of a way to pay balances on your credit card. All right, a couple more. Number 8, take out a small loan for an appliance or a computer and repay it monthly in full and on time. Good. Yep, thumbs up on this one. That's a pretty easy one. The things you're going to see pretty consistently: in full, on time. Those are really important words when you talk about credit. Number 9, get a secured credit card by opening a savings account with a balance equal to the card's limit. Yeah, that's a thumbs up. And we'll talk about secured cards a little bit. Again, if you are beginning your credit history, secured cards can be a really good way to get started and build your credit history from if you're starting from ground zero. All right, last 2. Number 10, overdraw your checking account for the same amount each month. This demonstrates a consistent need. Yeah, down. Not only is it bad for your credit, but it can get really expensive. If any of you have ever drawn your account, you know the fees and the charges that go with overdrawing your account can add up really, really quickly. So that's really bad on 2 reasons for why you don't want to do that one. And then finally, the last one, as you all are getting into college and moving through your early career, number 11, put your apartment and utilities in your own name and always pay your bills on time. Yeah, good. That's an easy thumbs up as well. Easy thumbs up. So good job. Hopefully you had a chance to look at this a little bit before. And we're going to talk about quite a few of these, but I think it's a good way for us to get started talking about some things you might want to think about and some things that we're going to be sort of going through as we get through the presentation. So I'm going to go back to the presentation here. Bear with me again for a second. very fast at this. I'm sure you guys are much better at this than I am. Okay, we get back on presentation. Yep, thumbs up. Okay, great. So let's start with some of the basics. What is credit? And why is it important to me? So credit is basically your ability to borrow money. There's lots of situations where you might need to borrow money. It could be to purchase a car. You may want to have a credit card. You may have student loans. And in each case, you're borrowing money from a lender and basically making a promise to pay it back. That's what credit is. The money that you owe to the lender is called debt. And when you borrow money, you're usually going to need to make monthly payments and have other costs potentially around interest and fees. So some really basic information on this one about just what credit is. So your keywords there: credit, debt. Principal is the amount that you actually borrow, and then one of the other things you're going to want to pay close attention to is interest and fees that you may be charged on top of the money you borrow. So benefits and risks of credit. You've probably heard both good things and bad things about credit, and that's really a true scenario. There are positives and there are negatives. Obviously, having the ability to borrow money when you need it gives you flexibility. It can help you with a purchase you want to make, and it can also be really helpful if you get in a situation where you're in an emergency and you need money fast. The downside, of course, is that borrowing too much money and being able to pay it back has become sort of a problem in our country. And that's where I think you hear sort of the negative side of using credit. What's important is to use your credit responsibly and also to make sure that you don't have too much debt where you can't get back out from what you've borrowed already. One of the keys to doing that is making sure you understand how credit works, how to use it wisely. And if you do that, it really can help you reach your goals. And in general, credit really, what you want to use credit for is to make it easier to buy what you want when you need it. That's the ultimate goal of using credit. So how do lenders decide whether or not to loan you money? If you're applying for your first loan, what are the things they're going to look at? We call this the 4 C's, the 4 key things that a lender will look at. The first one is your credit history. So what is your experience using credit? And we're going to talk pretty much in depth about this one in a couple minutes. Collateral is the second C, and that is really applies when you're talking about buying a home or buying a car. And the key point there is if you don't make your payments, the lender has the right to take that collateral back instead of getting the payment in money for the loan. The third one is conditions, which is basically what else is happening in the environment. So if you think about the current pandemic and the economic environment we're in today, right now lenders might be a little bit more conservative about lending money than they were a year ago. So conditions and what's happening in the market may also impact the decisions that a lender makes to give you a loan. And then finally is capacity. So basically the question of, can you pay back what you borrowed? One of the ways that a lender is going to look at determining your capacity to pay back the loan is called your debt to income ratio. This is basically, whoops, hold on, let's go back here. This is basically how much of your income you're spending on your loans or your debt. And it's a really simple calculation. You basically take what you owe every month, you divide it by your monthly gross income, and you get a percentage rate. So most experts recommend that in terms of your housing costs, so let's talk about your mortgage, the interest you pay on your mortgage, insurance for homeowners insurance, taxes, if you live in a community where you have to pay homeowners dues. So all of the costs that go along with your house should be no more than 28% of your gross monthly income. So a lender, if you're going to get a mortgage, will make this calculation. If you are over that 28%, That's going to be a red flag to them that they might need to consider some other things in your credit history. And then in terms of all reoccurring debt, the number you want to look at is ideally less than 36% of your monthly gross income would go to all of your debt. So that's the housing we just talked about, plus things like your credit card payments, if you have a car loan, if you have a student loan, if you have other debt that you have to pay, all of those numbers combined should be less than 36% of your gross monthly income. So as you can see in this example, this person makes $2,600 a month before taxes. So that's what gross income means, before taxes. They currently owe $1,100 a month, and they're just over the recommended amount at 42%. The one thing you want to keep in mind if you're doing this calculation is to remember to use your gross income. So how much you make before taxes, not your actual take-home pay. If you do that, you're going to skew your percentage a little bit off. So use your gross monthly income when you're calculating this percentage. So now that you know why you would use credits and how much debt you might want to take on, your next question might be, okay, so where do I get started? We talked earlier when we went through the quiz about secured credit cards. So secured credit cards are backed by a cash deposit. So you open an account at a bank and they give you the credit card for that same amount of money. So they're a really great way to get started if you don't have any credit, or in some cases, if people have bad credit, a secured card can help them get back on track. Again, if you don't make your payments, the lender or the bank has the opportunity to go and take that cash that you've put on hold with the credit card to pay back the loan. The other great place to really start is something like a retail card or a gas card. And the reason that we say that is typically those types of cards will approve people either with lower credit scores or less credit history. So it's a good way to get started to get a first card. They also report to the credit bureaus, which we're going to talk about a little bit more. And so if you pay those as agreed, it's a great way to start to build your credit history. If you get a gas card, it also limits you. You may not be able to, shop online. You can't buy things on Amazon. So it's a good way to sort of control what you can buy on credit. So a good place to get started. And if you manage your secured cards or your retail cards or your gas cards well, it can really help you establish your credit and or improve your credit for people that have gotten into trouble. This is sort of something that's a way to go back to ground zero and really get started again. So we're going to start talking about 3 different types of credit. We're going to talk about loans, we're going to talk about lines of credit, and we're going to talk about credit cards. And what's the difference between a loan and a line of credit? You may have heard these terms, but maybe not had a chance to really dive deep into what is the difference. So a loan is a one-time transaction. You get all the money at one time. You pick a set amount of money you need to borrow. You establish the terms. So you can say, I need to borrow $1,000. You say, I'm going to borrow that over 2 years, and then you pay it back at an agreed amount over a period of time. So very cut and dry, single amount, specific amount of time, and a specific payment in a lot of cases. A line of credit is really a more flexible loan. So you agree on a limit, how much you're going to borrow, but then you only borrow as much as you need at the time you need it. And as you pay it back, you can borrow more. The trick here is you do still have to make a monthly payment. So once you've borrowed on that line of credit, you still have to make a payment. So it's not that you can put that payment off. It just works a little bit different, and it's a little bit more flexible than a traditional loan. To give you a couple examples of what that looks like. So a mortgage, a car loan, a student loan, a consolidation loan, those are all really good examples of a straight loan. Probably the most common form of a line of credit that you might hear about is called a home equity line of credit. And to give you an example of that, if I want to, let's say, remodel my kitchen, I might take out a home equity line of credit. So as I'm completing different parts of my kitchen remodel, I can write different checks to the different contractors as I'm completing parts. So it gives me that flexibility versus taking the money all out at once. Another thing like a remodel that could make a line of credit more useful is I might not know exactly how much that amount will be. So let's say I decide I'm going to bring a contractor in for the cabinets, I'm going to bring a contractor in for the floors. I might not know up front what that total is going to be. So by having a line of credit gives me a little bit more flexibility to borrow as I need it. So when you're thinking about, do I need a loan or do I need a line of credit, really what you need to think about is when you need the money and how you will use the money. And that will really help you decide between those two options of different types of credit. So I'm going to stop here for a second because I went through a lot of information in a pretty short amount of time, just setting up the basics. So before we move into credit cards, will be our next section. Any questions about just the basic information we covered on what's credit, why you might get started, and different types of loans?
I have a quick question.
Yeah.
Okay, how long does it typically take to build credit? Because I've had a loan since July, I think, and when they ran my credit the other day, they said I didn't have any.
Yeah, and that's one of the reasons you want to get started, sooner rather than later, where you're in a position where you can make payments. Is it does take a little while to establish your credit history. And when we talk about credit scores, that takes even a little bit longer. And so I think I would give you probably a guideline to say it's going to take you a year or so before that credit history really starts to build and to show up and to create a credit score. So again, one of those reasons to potentially think about starting a little bit earlier once you have the ability to pay back on a card. Great question.
Okay, thank you.
Yeah.
Christy, we had another one in the chat from Olivia who asked, how do you find gasoline credit cards and what are the best ones?
So if you're at a gas station, in a lot of cases, so think about like the larger chains of gas stations like a BP or a QT probably has credit cards. You can apply for credit cards at those gas stations. I think I would stick with sort of the larger, more reputable gas companies if I were looking at a place like that. And then when we talk about credit cards, we're going to talk a lot about sort of shopping different cards and what you need to look at before you select the card. So we'll get a little bit more into that, and I think that will give you some information about what you want to look for if you're pulling those, for example, applications, or you get information from a couple of those different gas stations, which card you might want to pick.
We have a few more questions from the chat. Praises ask, does your credit history build faster if you have more credit or credit cards?
I think it will take about the same amount of time. It depends when you get them. So you're probably not going to get all of your credit at one time. So it will build on itself. So let's say you start with your gas card and then let's say you add it, you end up getting a student loan to help. That's going to build on each other. And so it will technically, you'll get a credit score and you get a little bit more history as you build on it. But I wouldn't recommend, get everything at one time to get your credit history started, if that makes sense.
And one more came in. What are the benefits of having a gasoline credit card? Which gasoline company do you recommend?
Yeah, so we'll talk about how you can compare those again. The benefit of doing that, I think, is, again, those cards, they report to the credit bureau, so it starts to build your credit history. And again, just from a really practical standpoint, it sort of limits what you can buy. And so you may not be, again, as tempted to quickly order something you saw on Amazon or Instagram or one of those places. You can't do that with a gas card. What you can do is pretty much buy gas. And so that helps you start small and with a really specific thing that you can purchase. And then once you get comfortable, this is what I spend, this is what I pay back, then you can look at adding credit cards that give you more flexibility and you may be able to purchase more things. So that's sort of the benefits, a little bit of a control factor in using something like a retail card or a gas card.
And we had another come in. These are great questions, y'all.
Yeah, that's great.
What's the best timeline to pay off your credit cards? And should you buy credit cards when from your banks or credit unions?
Yeah, so our next section is on credit cards. So we'll talk more about paying things back, where you should get cards, what you want to look at. I think we're starting to lead into some really good questions on our next section.
Perfect. And this probably will lead in. We had a follow-up with about the gas. If you could use a regular credit card for gas, if I use a regular credit card for gas, should I get a gasoline credit card? But it sounds like we're heading in that direction.
Yeah, yeah. And I would say, again, you're going to want to think about where you use your cards and what you would use them for. And so if you already have a regular gas card or a regular credit card, you may not need a gas card. Again, you don't want to have too much credit. So really think about, how much do I need? And we're going to talk a little bit more about that in terms of some guidelines of what you might want to have. So let's dive into the credit card section. And then again, we'll take a pause after that for some more questions if there's things that we didn't answer. So credit card 101. So first thing, I'm curious, and I can't see all of you, but who has at least one credit card today? Okay, and Grace and Catherine, are we getting like, can you see more people than I can? Better sense of half the folks, a handful?
Yeah, so if y'all want to chat, and we've gotten a few chats that people have
Yeah, okay. Okay. And
Yeah.
then I think, as we go through this section, one of the things that I would encourage you to think about is how many credit cards you have. And that could be, I don't have one, and should I consider getting one? Or it could be a question of, I have a card, do I have the right amount of cards? And so I think that's sort of what I would encourage you to think about as we go through this presentation. So to get us started, I'm going to start with a few sort of general questions. So the first question, again, this is a true or false. When I use credit card to make a purchase, I am borrowing money. True or false? Give me a thumbs up if it's a true. Yep, absolutely. This is true. You are borrowing money. It's just like a loan, even though it's a piece of plastic. So don't forget that. Whatever you borrow, you have to pay back. Really simple, but important thing to remember. Next question. This one, I have a new credit card with a $1,000 credit limit. I should always keep what I owe below what percentage of this credit limit? Anybody want to hazard a guess of what that percentage should be?
We have a lot of A's coming in.
A lot of A's coming in? Yeah, this is a little bit of a trick question because technically any of these answers is correct as long as you stay below your credit limit. But the recommended answer is actually C at 70%. So keeping your credit card balance below 70% of your limit is really good, smart money management. So what that shows is, one, you can control use. So again, you're not maxing out your credit card. And the other benefit is if you would need it for an emergency, you have a little bit of cushion within that 70%, that additional 30% that you could use in case of emergency. So of course, if you can budget and manage your money to stay at 30%, that's ideal. But know that actually you have a little bit more wiggle room, and as long as you stay around the 70% range, that would be a good way to manage your credit card. All right, next one. Last question here. Let me know this one. So the APR information on my new credit card refers to A, the amount of credit I have available, B, the interest rate set by the government, C, my annual fee, or D, what's used to compute my finance charge. I want to try and see.
Lots of B's and C's coming in.
Lots of B's and C's. Okay, APR is a really important thing you want to know when you start talking about loans and credit cards. So APR stands for annual percentage rate. It is the interest rate that is used to calculate the interest that's going to be charged on your balance if you don't pay it in full before the due date. So the lower the APR, the lower the cost of the loan to you. So if you are looking at credit cards, APR is something you absolutely want to pay attention to. And I'll show you an example of how this works in hard numbers in just a couple minutes. So good job on the questions. Thanks for engaging with me on those. And we're going to talk a little bit more to give you more information on all of these. So just some credit card basics. One thing I would start out that's not on here is talking about the difference between a debit card and a credit card. Debit cards are linked to your checking account. So if you have a checking account, you can get a debit card that goes with it. When you use the money on a debit card, it's automatically debited, which is why they call it a debit card, from your checking account to pay for your purchase. You have to have the money at that time to make the purchase. So if the money is not in your checking account, you can't use your debit card. The credit card, as we talked about, is the card that allows you to borrow money to make the purchase or payment. So if you don't have the money you need in your checking account, a credit card would be the alternative way to purchase that item. But again, as we said, you still have to pay back the full amount that you borrow. And on a credit card, you may be able to pay back the full amount, you may be able to pay part of it, or you can even make a minimum payment. If you pay the full amount before your due date, you're usually not going to have to pay interest or fees on the money you borrow. We're going to talk a little bit more about that in a minute too. So just some good hints and tips on this basics page. So selecting a credit card, this is what we were talking about. A lot of you were asking questions about, so how do I pick a credit card? What's a good credit card? So all credit cards are definitely not the same. When you are considering any kind of credit card, make sure that you actually sort of shop around. Things that you're going to want to look at, first of all, is the annual percentage rate. So we just talked about that. That's the interest rate that your bank or whoever's issuing the credit card is going to charge you. The other thing you want to look at is there an annual fee with this card? A lot of rewards cards will charge you an annual fee. Also, some of the higher end cards will charge pretty substantial annual fees. So look at the fees, look at any penalties. You might also want to look at your credit limits. So if you're starting out with a new card, ideally you want to have a lower credit limit. And so you might want to be able to compare across cards, what's the credit limit I can get? And then again, we talked about things like rewards or cash back. You see those types of ads on TV all the time. You know, what's in your wallet, all these rewards, all these cards, those are other things that you compare as you're thinking about a credit card. Most important thing I think you want to look at is the APR that you'll be charged. So let's talk about why that's important. So here's an example of why APR matters. So at an interest rate of 24% under scenario 1, you will spend almost twice as much as the interest rate of 14% if you're only making a minimum payment. So you'll see $3,200 versus $1,500 is the difference between those two APR rates. The other thing you'll notice, it's going to take you almost twice as long to pay it off. So at the 24% interest rate, I'm going to have to make 183 payments of my minimum monthly versus a 14% rate, I'm only going to have to pay 92 payments. So credit cards have to tell you very clearly what the APR rate is that you will have to pay. If you're looking at credit cards and you're looking at different types of cards and you don't see that APR really clear, or it feels like you can't quite get your head around what that interest rate is, find another credit card. It needs to be really clear to you, what is that rate that I'm paying? And again, you should be able to compare across different cards. This card might be at 14%, this card might be at 16%. This scenario gives you an example of why even a percent or two can really make a difference in that card. So really good way to compare cards is to look at things like that annual percentage rate. Once you've gotten your card and you found a good APR, some other things that you need to think about are how you're going to manage the card. So how am I going to use this card? So will I pay off my balance every month? Will I just make the minimum payment, or can I maybe pay a little bit more than the minimum payment, even if it's not the full amount? While at the time it may sound good to just make that minimum payment, what you want to think about are the long-term consequences of making only that minimum balance. If you do that, the interest that you are paying continues to build on not only the purchases that you make now, but on the past purchases that you've made as well. And if you get your balance high enough and you're only making those minimum payments, it can take a really long time to pay it off, and it'll cost you a lot more money. So let's look at an example of what this looks like. So again, here are two scenarios of people that have borrowed the same amount of money. So you can see up at the top, they've made purchases of lattes, pizzas, movies, and smoothies, and they have a balance on their account of about $2,100. In this example, though, scenario 2, is the person is paying $168 a month towards their balance versus scenario 1, where they are making the minimum payment of $52. Across those two scenarios, scenario 2 pays almost $1,200 less in interest, and they pay off the debt 8 years sooner by making that additional payment amount. So each credit card issuer will have a different type of statement, but again, they are required by law to make sure that this information is really clear to you. So your billing statement should usually have something on it that will tell you this is how long you will have to pay if you pay minimum payment only. These are payment details on just the minimum payment amount. So when you get your credit card statement, look at that information, because the bank or the lender has to tell you how much it's going to take you to pay off if you're only paying that minimum amount. If you're not paying off the full balance every month, you really want to look at that information closely, just so you have an understanding of what that monthly payment might be and how long it's going to take for you to pay that off. And in this case, again, you can see if you can pay even more, even if it's not the full amount, but you can pay a little bit more than that minimum payment, it really can pay off long term in terms of how much you have to pay and how long it's going to take you. The one other thing I really want to talk about as it relates to credit cards is a cash advance. So in this case, notice the annual percentage rate, that APR that we talked about earlier. In this case, on a cash advance, the APR is 27%, and that's pretty typical. So the APR on a cash advance is usually much higher than what you would pay on a purchase. You can also be charged, as you see in this case, additional fees by your credit card company for taking a cash advance. The other thing that's really important on a cash advance is usually that interest starts the day that you take that cash advance. So on a credit card, if you purchase at the beginning of the month, but your bill isn't due to the end of the month, you have that full month where you're not incurring any interest on those charges. With a cash advance, as soon as you take that cash advance, the interest starts to charge. So you're going to be getting charged that 27% right off the bat. So again, in this case, somebody who borrowed $1,000 through a cash advance is actually going to be paying almost $1,800 in additional interest. So my advice around cash advances is only use them in case of extreme emergency. Otherwise, you could be paying off this sort of really expensive way to get money for a really, really long time. Last thing, I think we'll close out this section and see what questions you have around credit cards is obviously around credit card safety. So you'll see a lot in the news around internet safety, using your credit card. The basic thing to think about is treat your credit card like it's cash. You know, it's valuable. You need to protect it. You need to know where it is. The other thing I would say is avoid lending your credit card to someone else. Even if a friend is like, hey, I just need a short-term loan, can I use your credit card? Really best to avoid that, because at the end of the day, it's your credit that will be impacted if your friend has problems paying it back. So treat it like cash and really keep it to yourself, and don't share it or don't use it as a short-term loan for friends or family or people like that. So let's just review, and then I'm curious to hear what questions you have. So far, what we learned is shop around, shop for the credit card. So when you all were talking about gas cards, asking which one is best, you're really going to want to compare. Figure out which cards have the lowest APRs. Think about which ones have the lowest fees. The other thing that you may see on some credit cards, and they've really gotten away from this a little bit more, but are introductory rates. So you may see a credit card where they say great introductory rate, 0% or 5%. What you want to look at is what is that rate going to be once sort of the teaser or the introductory period is over. So before there were a lot of laws in place, credit card companies would say, great, 5% rate. Once that expired, they would take you up to like a 25% rate. So be careful about introductory rates and make sure you know what that regular everyday rate is going to be. And again, look at fees, penalties, read that information really carefully, and that will help you really figure out what's the right card for me. Before you use a credit card, before you even get started, think about planning your spending. So how much can I really afford to pay back a month, and make sure that you don't borrow more than you can afford to pay back. It sounds really simple, but if you think about that up front, it will avoid you sort of getting into trouble as you make a purchase that maybe you can't afford. You also want to keep track of what's that money coming in and what's that money going out. You also want to look at your credit card statement. I talked about really paying close attention to what it says around your APR and what it tells you about making those minimum payments. Read it when you get your credit card statement. Don't throw it in the trash. Don't ignore it. It's really important to know your minimum payment amount, your payment due date, and any fees or penalties that come with that. You also want to, when you get your credit card statement, look for errors. It's possible that a company could have double charged you, and you want to make sure that you're looking for those types of things, as well as how you're spending your money each month. You might look at this and say, oh my goodness, like in my case, I went to the coffee shop way too many times last month, and if I add it up, I actually spent $120 on coffee last month. Credit cards are a great way for you to really track and see where you're spending your money. Let's see what else I want to tell you about this. As we talked about, if you can pay more than your minimum payment and you have the opportunity to do that, always do that as a first choice. If you can't pay it off completely, try and make more than the minimum balance. And then, as we said, avoid credit cash advances. Really an expensive way to borrow money and not recommended. One last sort of good rule of thumb for you to keep in mind is to keep your credit card debt so that your monthly payments are no more than 10% of your monthly income. It's a great guideline to make sure that you can pay it back. If you need sort of a number to keep in mind, whatever you bring in as your take-home pay, 10% or less of that should be what you owe on your credit card every month. A really good sort of guideline and tip. So that was, again, a ton of information in a short amount of time. And I'm looking at time and I'm not doing very well on staying my 45 minutes at all.
You were okay?
So, yeah, so let me see what questions you have about credit cards.
Christy, we have a few coming into the chat. The first one is, what is the lowest APR for a credit card?
That is going to depend a lot. It'll depend on the current environment. It'll depend on how competitive lenders are being around credit cards. You can go to places like bankrate.com and it will give you a sense of what current interest rates and APRs might be on credit cards, but it really does vary based on the economic environment and also how competitive their credit cards will compete with each other. So if someone really drops their APR, then other companies may follow suit. So again, that's one of the reasons you want to shop around quite a bit.
Another one, why don't you want to have too much credit?
So if we have time, we're going to fly through a session on credit history and your credit score. If you have too much credit, it will impact your credit score, and eventually that will hurt you when you try to get more credit.
Another one coming in from the chat is, when should you pay the balances on your credit card? And do you pay it a few days before the balance is due or on the day of?
Yeah, as long as you pay it by the due date, there's really, unless, there's not a benefit to you of paying it before the due date, unless you have that money and you want to pay that off before you spend the money somewhere else. Then in that case, you might want to pay it when you have the money. but you're not going to incur additional interest until after that due date on a credit card. So pay it on the due date at a minimum, unless you need to pay it earlier to get the money out of your account.
Then we have one more question come in on the chat. Does getting a credit report lower your credit score?
Yeah, we're going to talk about that, and it depends on how you get your credit report. So let me try and go through this section really quickly, and then Grace and Catherine, I will make sure that you all have this presentation that can go out to the group, and you can sort of look through some of this when you have a little bit more time. But let me at least try and go through some of this pretty quickly. Are you guys okay with that? I know we're over time.
Yeah, no, you're our last workshop. So we've given ourselves a 15-minute barrier. So you're
Okay.
good, Christy.
Okay, all right, I will try and move quickly. Thank you guys. So why is credit important? Why does this even matter? So credit history, let's talk first about credit history. So how you manage your money is called your credit history. Lenders and others, like if you are applying for an apartment or you are applying for utilities, all of those people will likely look at your credit history. So that's why building credit history and managing your money well is important. You'll see here there's 3 credit reporting agencies that track your credit history. They also track where you live, where you work, and how long you've been there. Some frequently asked questions. What I would point out on this page is by federal law, you can get a copy of your credit report free once a year. It's a great thing to do. It's a great habit to make, to check your credit history once a year. The best bet, somebody asked if can you get a credit report will affect your credit history. The best thing to do is to go to this website, which is annualcreditreport.com. You will see lots of advertisements for other websites that advertise free credit reports. What I could say is some of them are legit, but some of them will actually use it as a way to sell you other services. So the best place to go is to this annualcreditreport.com site. When you get your credit report, your first thing, really your primary goal of doing that is to look for mistakes. That's really what you want to do on your credit report. So this is a sample of a credit report. And again, you guys can look at this more closely when you get this back. What you'll see are the different sections on here. And again, what you want to look for is this information correct? Do they have my name right? Do they have my address right? Is there anything on here that doesn't look right to me? I'll give you a really quick example. My brother and my dad is Peter Taylor, my brother is Peter Todd. Their credit gets mixed up all the time because the names are the same. You happen to have people in your family with similar names, or you're a junior or a senior or a third, that stuff happens all the time. So really important for you to make sure that this is accurate. The bottom part of this section, you'll see companies that requested your credit file. The reason this is important is different companies will request your credit report. So if you're shopping for a loan and you've talked to a couple different lenders, you may see multiple inquiries on here. The important thing to know is if you ask for a copy of your credit report through that website, it doesn't count here. But if you have lots of lenders that are hitting your credit report, it can actually affect your credit score. And I think that's what someone was asking. But getting a copy of your credit report does not impact that. So again, good practice to get it at least once a year. This section is a blowout of that credit history section. Again, what this is going to show are the different creditors, the different types of creditors that you have. Again, important, check to make sure you recognize the names. Is the loan amount right? Is the balance right? And especially, is your payment history accurate? So what you'll notice on this one is this person actually hasn't made their car payment in about 90 days. If that's not true, then you need to do something about it. So again, get your credit report, look at it, and make sure it's right. That's your key takeaway from this one. This is an example you can look at in terms of someone who had an issue on their credit report. What I would tell you is it's your responsibility to fix it. Don't count on someone else to fix it for you. Don't count on the credit bureau is going to realize it's wrong and they're going to fix it, or the company is going to realize it's wrong. You need to take responsibility. If there's an error, call the credit company, call the credit bureau, call the person, the creditor that has it wrong, and try and get it fixed. that's really what you want to do, and do it as quickly as you can. It's really, you have to take your personal liability for that. It's probably not going to fix itself as much as you would like it to. All right, summary. Get your credit report, read it, make sure you don't find errors, and if you do, fix it. Take personal responsibility and get them fixed as quickly as possible. That is the down and dirty credit report section, really fast. Let's take a couple minutes too and just talk about credit scores. So what's important to know about credit score is once you get your credit report, the other thing you might want to know is what is your credit score. And your credit score is going to impact a couple of different things when you go to get a loan. And so you want to know what that credit score is. And on this page, you can see there's lots of different factors that go into your credit score. It can be the types of credit you have, obviously how much you owe, the length of your credit history. So we were talking about building that credit history over time is going to help you get a better score. Obviously, how you make your payments is going to impact your credit score. And then if you're getting a lot of new credit, so like I said, you probably wouldn't want to go and apply for 4 or 5 credit cards all at one time. That's negatively going to impact your credit score as well. These are all things that are going to feed into what ultimately your credit score is. So what is a credit score? It's both your credit history and your credit score are going to be important. They range, they're on a number basis. So they start at 300 and go to 850. 850 is good. 300 is really bad. Typically what I would say is any credit score that is lower than 630 is considered a low credit score. So the number you want to try and keep above is over 630 is going to tell you have a good solid credit score. Christy, why is this important? Why do I care what my credit score is? This is another one of those examples where you can see how a loan or a credit score will be impacted by your credit score. So buyer 1, their credit score is 590. We said less than 630 was not great. Buyer 2 has a 740 credit score. Look at the difference in that APR. So one, you are at almost 16%, and the other, you are closer to 5%. So your credit score can make a huge difference in that APR. And then as we learned, that impacts your monthly payment, it impacts your interest, and it impacts how much you pay over time. So that's why a credit score is important to you. Next page we had here, you guys can go through this and I can send the answers on this one. These are different things that will impact your credit score. And you'll see sort of like the true and false we did, there's various things here that will improve your credit score and other things that will lower your credit score. So I'll get you this page with the answers so that you can look and sort of see what those different cases are and how it might help you improve your credit score. This is sort of my wrap up. I think, one of the things you want to think about is what did you learn, and is there something that surprised you the most? What I would recommend is maybe think about 1 or 2 things based on what you learned today that you might want to do. So if you don't have a credit card, maybe this is time for you to go and consider one. Or if you have a couple and you realize like, wow, I really need to go look at my APR or my fees, or I need to start making my payments differently. Hopefully you got something out of this presentation that you can go and take action on pretty quickly. The one last thing I sort of want to wrap us up with are a couple tips around what to do and signs that you might be getting into trouble with credit. So you can see a list here on the left side. If any of these things start happening, it's a red flag to you that maybe my credit use is getting a little bit out of hand. So let's say, for example, you have a savings account and you're usually pretty good about taking part of your monthly income and putting it into the savings. If you stop doing that because you're making those payments on your credit card, that's a red flag. You don't want to keep doing that. If you're feeling stressed over managing your money, bad sign again. Having a credit card should not make you stressed if you are managing it well. And then the last thing I would say is if you get in a place where you feel like I'm paying forever, there is no way, even if I make all these minimum payments, I'm still paying off things that I charged a year ago. I just can't get ahead of this. That's another red flag that maybe you need to take a different step and start to get your credit back under control. On the right-hand side are some tips. What I would tell you is if you start to experience any of these or you feel like you're getting underwater with your credit, the most important thing is to do something. Just don't ignore it. Don't hope it will go away. There are credit counselors. There are lenders that will help you. It won't be a quick fix, so it's not like you make a call and tomorrow instantly everything is better. But the sooner you start and the sooner you take action, the better your chances are of getting your credit back under control. So hopefully if you use all the tips we learned today, this will never happen to you and you won't have any of these things on the left-hand side. But if you do, or you know someone that is feeling some of these things, tell them to take care of it and get help. That is the best advice I can give you. So really quick crash course. I hope this was helpful. And if you have questions, I'm happy to stay on longer. But I also understand it's a Saturday and you all want to get back to the rest of your day. So thank you so much for spending time with me, and I hope you got some valuable information.
Awesome. Thank you so much, Christy. Does anyone have any quick questions? We have about 2 minutes. If anyone has anything, y'all gave great questions throughout that entire presentation. We had one come in, Christy, and this will be from Praises. How long should you wait before getting a new credit card? Does terminating a credit card lower your credit score? That's a great question.
That is a great question. And that probably depends on your credit history. So if you have a lot of credit cards and you get rid of 1 or 2, that's probably a good thing. If you have a really limited credit history and you get rid of all your credit cards, that's a bad thing. So eliminating a card, depending on what your credit history looks like, could be good, could be bad. You want to sort of consider the big picture in terms of what you had before you would cancel the card.
Awesome. That's great. Thank you so much. Thank you for that last question too, Praises. That was awesome.
Yeah. One last tip really fast, handsonbanking.org. I'll send that as well. But if you want to go into more detail or you want to do some quizzes, this is a great resource for you. It's very interactive. You can go through the information. Would be another great reference I would leave you with.
Awesome. Thank you. Yeah, I'll make sure to get all of this from Christy and I will get this sent out to you all next week sometime. And also we have recorded this whole workshop and we will send out those recordings as well. So if you need to come back and look at something, or I've been chatting all of the links out that Christy is saying, so those will be accessible as well if y'all want to go back and view those. But this was incredible. Thank you so much, Christy. Thank you all so much for joining. And there is within the next few minutes, there's going to be an email coming to your inbox to do your post survey. It's your final requirement for the Ready to Thrive Scholarship. So make sure you fill it out. It only takes a few minutes. And we want to just thank you so much, Christy. And y'all have just the best rest of your Saturday and your weekend.